for now, let's turn the attention back to markets. Mayuresh Joshi, fund manager at Angel Broking, joins us on the show. Afternoon, Mayuresh. Thank you for speaking to us. A sharp slide coming into markets yesterday. A pretty range-bound session today, and more crucially, that range between 9,000 and 8,500 still seems intact for the markets. Going forward, is this the likely action until we see the outcome of the US presidential elections, of course, next week, and more importantly, the Fed rate hike? The Fed also hinting that possibly December is when they will hike rates.
Afternoon. Oh yes, absolutely. I think that event risk is on the table, and once that event risk is over, in whichever direction, if Trump comes in, I think the markets have not factored that victory. So I think you are seeing some amount of repercussions happening on global equity markets. If Clinton comes in, I think it's largely priced in as well. So I think that range might very well be maintained. But again, I think if the results come through on the event day, you might see a sharp reaction if Clinton doesn't come through. Having said that, probably I think the Fed rate hike to a large extent also has been gestated by the market. A nominal hike will come through in December. How the markets react post the US presidential elections is altogether a different take. So in that sense itself, I think the markets are going to be on tenterhooks till we see a decisive outcome of the US presidential elections.
Sure. Mayuresh, first of all, thanks a lot. It's always a pleasure to have you on the show. Wonderful speaking to you this Thursday afternoon. Just wanted to also ask you, there's an opinion that Indian markets are only going to get stronger and stronger. And this is probably one of the best places to be when it comes to global markets. Do you think that any kind of correction is the time to go into?
So after yes, I think structurally India is best placed in the entire emerging economy pack. You look at the kind of reforms that have got initiated by the recent government. You look at our currency structure, the forex reserves are extremely strong. And even if you adjust for the FCNR repayments that are due over the next month, my own sense is that our foreign exchange reserves are very robust, so that gives a very strong hand to where the currency is played out. Thirdly, I think in terms of the corporate earnings structure itself, my own sense is that post Q4 you will see a decent uptick happening on the Indian macroeconomic scene, which will trickle down to the corporates, and the corporate earnings parameters will start appearing much better. So our own sense is that for the better part of FY18, 14-15% earnings growth is not ruled out. So yes, I think structurally we're very well placed. What happens in a global meltdown, I think India will get affected on that front. But largely again, I think my own sense is that if you've got 100 rupees to invest, you should be investing around 15-20 rupees at any given sharp correction in these Indian markets.
Mayuresh, since you touched upon earnings, crucial bank earnings awaited. A lot of private and public large caps still to report those numbers. Judging by what we've seen from Axis Bank and what's been happening on the bank nifty over the last few trading sessions, what are your own expectations on the banking space, on bank earnings, the outlook going forward?
I think I'll divide that question in four parts. The retail larger private sector banks have done exceedingly well in terms of numbers, both in terms of their loan growth. The retail advances have done exceedingly well. Asset quality has remained extremely stable because of their retail book. On the corporate lending side for the larger private sector banks, you've already seen pain. The drill down lists have probably got narrowed down with large provisioning taking place. Take for instance Axis Bank. And again, I think that trend would continue for the larger part of FY17. What this has done for the system is that the larger credit costs have increased, and elevated credit costs have probably dampened return ratios, both ROAs and ROEs. So I think the markets are factoring in that FY17 probably would be a washout year, with larger provisioning taking place and a large part of recognition from the drill down list actually coming onto balance sheets. But going forward in FY18, as credit growth starts picking up from the higher single digits that we've seen into double digits, and with the base that they'll have going forward, strong capital adequacy ratios, as well as asset quality pressures going down, credit costs going down, absence of interest rate reversals, one sense is that private sector banks should report steady earnings. The larger public sector banks have strong fundamentals as well, and again I think the large part of asset recognition has already started taking place. So even one discounts FY17 to go in asset recognition and again higher credit costs, the same logic would work for a few larger private public sector banks. When it comes to the mid-cap PSU banks, I think capital adequacy is still an issue, and again I think the bridge in terms of receiving capital from the government is mandated to carry on the normalized rate of growth. So I think the growth capital is probably available with the larger private sector banks, not with the PSU banks, which will again get offsetted again with larger part of non-interest income with bond yields coming down, and that portfolio might shine. So valuations might look attractive, but again I think the return ratios look very, very soft for the mid and small cap PSU banks.
All right, Mayuresh, fair enough. In fact, let's stick to certain sectors and the results that we're watching out for, because Ambuja Cement is, of course, something that we're really looking at carefully. It is likely to post a sequentially weak Q3, but stable quarter on a yearly basis. Pranay, of course, has been tracking that very, very closely for us. Pranay, just take us through what we should really be watching out for with Ambuja.
Well, so as you said, it's expected to be a sequentially weak quarter, but on a year-on-year basis, it's most likely to remain stable. Let's start with the base numbers. The profit is seen at around 245 crores. This compares with the number of around 154 crores in the year-ago period, but if you adjust for the overstated depreciation of 27-28 crores, the number will be 180. But in any case, it's expected to be stable on the profitability end. Sales are seen absolutely flat at 2108 versus 2095. Now, let's relate this to the volumes, because the volumes are seen a little lower. 4.65 to 4.7 million tons is where the expectation is. This compares with the 4.82 million tons in the base year, 5.76 million ton in the immediately previous quarter. So some cool off in terms of volume is expected this time around, but the realizations are seen higher by a range of 2.5 to 2.7%. Now, in a lower volume environment, the realizations are likely to compensate for the lower volumes, and thereby you have a flat revenue expectation. On a year-on-year basis, of course, sequentially it's lower. The EBITDA is seen at 404 crores versus 322 crores. Again, 322 is adjusted for the overstated depreciation, and this translates to a margin of 19.2% versus 15.3% in the year-ago period and 22.9% in the immediately previous quarter. Sales volumes, as I said, range between 4.65 to 4.7 million ton. Average realization seen between 4385 to 4390 on the higher side, and the EBITDA per ton is seen cooling off. In the previous quarter, it was close to 1,000 rupees per ton. This time expected, and it's a broad range again, 720 to 900 on the higher side is what the expectation is, and in the year ago period it was around 650 rupees per ton. Watch out essentially for the operational cost metrics, because the petcoke reliance has gone up to almost 60-65% compared to 40% in the year ago period, and petcoke costs have benefited them. However, in the second half you can expect the margin contraction on back of petcoke to come through, because petcoke prices in the recent past have really gone through the roof. And otherwise, in terms of freight and forwarding and fuel charges, expect some rationalization also in terms of the split between the road and rail freight, but expected to be a stable quarter on a year ago comparison, and margins are seen at around 19.2%.
Mayuresh, I'm just, Pranay, thanks a lot for taking us through those particular numbers and what we really should be looking out for when it comes to Ambuja Cements for their results. Mayuresh, just coming to you on this, what is your take on that particular company? What are you looking out for, and what do you think is a reasonable target if one was to have one?
Again, as Pranay was mentioning, on a quarter-on-quarter basis, you're obviously going to see volumes being on the softer side with the kind of monsoons that we witnessed. So 5.8 million tons is what they had done in the June quarter. Our own expectations is around 4.7, 4.8 this time round. If you look at realizations again, I think the north and central regions, the realizations have been extremely strong. Again, I think not a significant presence in the south, so realizations should show significant improvement on a year-on-year basis, and a marginal improvement in that on a quarter-on-quarter basis. So in the June quarter, they were almost 4,412 rupees a ton. It should show a marginal improvement from those numbers. When it comes to the operating performance, I think the EBITDA per ton should largely be in the range as per consensus. So largely, I think it's going to be a story on how volume growth pans out in the coming few quarters, with the government emphasis and impetus on roads, highways, the housing sector. The cement sector should benefit generally, and the capex has been done for the cement sector over the last 4 to 5 years. So in terms of the gap, the utilization levels still languishing around 75%. Once that start picking up, the ROEs and the ROCEs start improving for these companies. Valuations might look a lad bit expensive at this point of time, but my own sense is that I remain positive on the sector as a whole. One can be stock selective out here, but I think I like Ultratech out of the large caps at this point of time. Ambuja, I think I really need to wait for the numbers. If it comes as per expectations, the management commentary will be key.
In fact, all cement stocks at the lows of the day. Ultratech, Mayuresh's top pick over the long term, but just in trading action today, Ultratech at the lowest point of the day. Ambuja ahead of earnings, also weak. Grasim under pressure, ACC under pressure. So Heidelberg, India Cement, all of them seeing cuts in trade right now. Of course, watching out for those earnings. Let's see what happens over there. Mayuresh, I also want to talk to you about the auto space and everything that's happening over there. Just before we do that, let's play out what the management of Escorts had to say. They have seen a tremendous rise in October sales for tractors. Here's what they had to say on the outlook going forward.
To the factor, I think, which is the key, probably the growth of the industry. I think it's a good monsoon which we've seen last year, and the pent-up demand for the last 2 years of degrowth of the industry, what we have seen. I think that's another thing which is great, and everybody expecting the record Kharif harvesting. So that's another thing which is really gone in favor. And then this was also the month where all the festivals were falling under the same month. So that's the thing, very rare phenomena which has happened. That's why the retails negotiate at an all-time high. So I think overall things are looking up. So we expect, I think the industry should continue to do well.
Mayuresh, going back the October auto sales, the kind of uptick that we were expecting for, let's say, something like a Maruti didn't really happen. In fact, on a year-on-year basis, it was slightly subdued. Similarly, for some of the passenger vehicle sales, it wasn't as big an uptick as you were expecting with regards to the consumption boom and festive fervor. But tractor sales have been especially strong, both for Mahindra and for Escorts right now. Signs of rural demand finally catching up with the kind of urban consumption boom that we've been talking about. And what's the outlook going forward? Also in the two-wheeler space, you've seen Hero Moto 5th straight month of 6 lakh plus sales coming in over there. So what's your pecking order within the auto space, and what are these trends telling you?
Again, largely, I think if you look at the broader universe, the farm equipment segment, which consists of tractors, for a large part of auto companies, I think the performance there has been exemplary over the past few months. Again, this is on the back of 2 years of drought. So with good monsoons coming through, that obvious uptick in terms of tractors volume going up and the sales realizations going up was an obvious impact. We've obviously seen a huge amount of crop being harvested, so I think the Kharif output is going to be at record highs this time around. With good moisture content, I think the Rabi sowing has been extremely encouraging at this point of time. So the farm equipment segment, including tractors, the volumes thereof are expected to stay at higher levels, and the realizations thereof as well will show an uptick. When it comes to the two-wheelers, I think the festive season, I think you saw a lot of stocking happening at dealer end in the coming month. But largely, I think as the festive season is over, I think it's all going to be a story on how the actual demand environment catches up. So if the demand environment remains extremely strong, and though we've got a situation where input cost inflation might actually start inching up, the leverage might pick up on their balance sheets if demand sustains and volume growth remains between that 10-11% range. So again, I think selectively Hero MotoCorp on declines is something that I'll still be looking at from a long-term perspective. For the four-wheeler and the passenger vehicle segment, you've obviously seen huge amount of platforms and variants come through. But again, I think individually you need to look and identify companies because you've seen huge amount of competition brewing in this space. So for Maruti, for instance, I think the kind of products that they've got across their product lines and a couple of their products doing exceedingly well, like the Baleno and the Brezza, I think it's showing encouraging trends for the industry. You're expecting a couple of launches happening from the Tata stable in the next few months. But again, I think that entire overhang on what is happening in the Tata group, I think that will create a big overhang on these stocks. So I think two-wheelers selectively is what I like, auto ancillaries is what I like, and selectively the farm equipment space is something that I'll remain optimistic about.
Mayuresh, away from this whole piece, let's talk about what's happening on the policy front. For sitting in the capital, we're tracking that crucial GST meeting that's taking place. There seems to still be a trust deficit really between the centre and the states. That April deadline perhaps seems to be a tall order. How do you think the markets have factored in the difficult labour of love that really is going to be GST in its final execution?
Again, I think the markets are waiting for a breakthrough happening through all the meetings that the government is having with the state finance ministers. So I think it's going to be extremely pertinent in understanding what kind of a roadmap is getting followed. The cess has become a contentious issue, but again, I think you will find some solution coming through. And I think the government is working towards pragmatic steps, and the government does want it to get pushed through. But again, I think the infrastructure readiness and the entire picture thereof, I think, needs to be studied carefully as well. So though the markets are anticipating that April 1 should come out, I think some small delays on that front is not going to carry a huge amount of deterrent in terms of how the markets perceive it. My own sense is that the government is making the right moves, all the efforts towards pushing through GST and getting in a pragmatic GST, though you will never have a perfect GST. But again, I think the markets will take that in that stride, even if it's delayed by a few months.
Right, Mayuresh, before we let you go, on a one-year basis, the surprise outperformer has been really the metals pack, the index up by about 57%, and individual names such as the Tata Steel seeing gains of 83%, Vedanta up over 120%. Going forward, what would be, let's say, if you could narrow down maybe one or two sectors that could surprise us over a one-year basis? It could be a contra call or something that you're really bullish on, but a couple of sectors that could really surprise the markets.
Now again, metals have done exceedingly well, and I think it's very difficult to time the commodity cycle. A, because the pricing thereof is extremely lumpy, and second, I think the demand pattern itself are not a clear indication on how the industry is functioning. So to that extent, I think the kind of run-up that we've seen in metal stock, both ferrous and non-ferrous, one really needs to take a stock-specific view on that one. A couple of sectors that I might probably like at this point of time is the transmission sector. So I think transmission is somewhere where a huge amount of underutilization had taken place, and again, I think within the sector itself, I think the transformer space is something to be keenly watched out for. Return ratio had become extremely subdued, unorganized players had taken huge amount of market share, and that will slowly start coming out as new norms start coming through and new registration processes start getting implemented. And again, I think the gas distribution companies, as I've always maintained, I think they've got a very robust business model. Yes, you will see some amount of downtick in terms of margins because the kind of capital expenditure that they're doing in terms of new outlays, and again the kind of pumps that are putting through. But largely, again, I think if one factors volume growth going forward and the EBITDA per SCM for these gas distribution companies, they should show significant uptick over the next 2 to 3 years, and the earnings profile should improve thereof as well. So I think gas distribution as a space and transformers as a space is something that I'm really optimistic about over the next 2 years.
All right, well, good to hear that. Mayuresh Joshi, Fund Manager, Angel Broking, thank you very much for spending that time with us on this show and giving us your viewpoints in terms of what potential bets are in the markets. Thanks for that. But still ahead on this show, we are getting you market guru Ramesh Damani's views on where to place bets in the markets and also why India continues to be the story that it is.